Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I'm Austin Wilson, co-portfolio manager at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us grow our podcast?
Subscribe. If you're not subscribed, hit that plus or that follow, whatever the icon is on your podcast player so you get new episodes when they come out on Thursdays. And we would love it if you'd leave us a review on whatever podcast platform you're listening to us on. That helps us help more people. So today, we are going to be talking about some common things that we see people doing, or rather not doing, when it really pertains to their taxes. And taxes are one of the two certainties in life, right?
Yes, death and taxes.
Death and taxes.
Yep.
And it's a very common thing to talk about, but we're going to hit on it today.
Yep. And first, we are not tax professionals. So what we're talking about today are just some thoughts, ideas, tips that we think are helpful, but always seek the advice of a professional before making any decisions on your situation.
So you know how we have that disclaimer.
Always.
This is not a recommendation, but if you have any questions about your financial situation, feel free to give us a call. Well, now we'll say we're not tax experts, but if you have any questions about your tax situation, talk to your CPA or tax professional, and they'll be able to help you out.
Yes. So we got 10 things here we're going to talk about. 5, we'll take a dad joke break, and then the last 5. And I'm going to kind of bring these up, and we're going to talk through some reasons why we think it's a good or bad thing that people are or are not doing these things.
Absolutely.
So the first one is a mistake that we see is people not keeping good records.
Ooh.
Yes.
Yeah,
and the reason why that is important is you file your taxes once a year. You have until April to file for the prior year.
April
and
15th.
Remembering in April what you did the January 14 months before is, just hard to do. And so keeping track, because there are a lot of complexities when it comes to tax filing, to know what you have to show as income, what you can deduct from your income, and keeping good records. And so being organized and keeping those records are important, because you can tell the IRS something, but if they audit you, you have to prove it.
Yeah.
And you need that proof, whether it's a receipt or whatever it is, that shows why I put it on my tax return.
Yeah, with this is somewhat tricky. So sometimes some things they automatically send you a statement for a given year. It can be, maybe it's a charitable place that you've given money to. They can send you a statement of what you've given from your church or whatever. Easy to file away. But things like cash donations, write those down.
Yep.
When and
date, what it was.
Yep. Because those are deductible, but you have no record of them, you don't get credit for them, so that's one thing. And just keep track of, as those papers come in, especially at the beginning of the year, you're getting in the mail a mortgage interest statement from your gains and losses on your investment accounts, and all these things. Make sure your W-2, put them somewhere safe. Keep electronic copies if you can. So I use cloud. My wife and I share an iCloud account. Obviously, we're Apple people.
Yeah, iCloud.
But so maybe some people have a box or.
Did you get emails
Google
saying
Drive
it's almost full and to buy more all the time?
See, no, I've already bought more.
Oh, okay, they already got you. They already got you. All right.
But anyway, so keep track. Scan those things in, date them.
Receipts.
They're there. Receipts.
Yes. Anything that you're going to use or claim as a deduction. So if you're a business owner, especially.
Oh my goodness, this is
your business has a lot of income. And then they can offset it with a lot of expenses. There are expenses in your business that reduce your taxable income, because if that's part of your normal business, you get to reduce that income.
You're only taxed
because it's no longer there.
You're only taxed on the profit.
Yes, right. That's really where we're getting to. So in order to get to that profit level, you got to prove those expenses. So keep those receipts. Using software like QuickBooks or something like that is very helpful to put that all in there. But you're going to need those records,
especially the larger your business or self-employment situation is. That the more those softwares like Quicken or whatever make a lot of sense, because you can link things and automatically pull transactions in, and it's so much easier. Yeah. As much as you can automate it.
Yes. So speaking of keeping track of things, deductions. So number 2 is people not taking advantage of deductions.
I like deductions.
Deductions are what they sound like. You get to deduct or reduce that income.
Yep.
Right? And so these are all all across the thing. But an example of itemized deductions are there's some healthcare deductions you can take.
Very hard to get, actually.
Yes, you have to be over a certain amount of
10% your
percentage.
AGI.
Yeah. And so, but those are available. There is charitable giving, which is always a big one, interest deductions. And so if you have a mortgage, things like that, you can deduct the interest you pay and goes in there. Now, most people take the standard deduction because it's so large, their itemization doesn't get there. But there are other deductions that are not in there that you can still take. Right. And we're going to get to that and talk about that in number 5. So I'm going to hold off on it. But there are things that are outside of that standard deduction or itemized that you get to reduce your income by.
Deduct what you can.
Yes,
everything you can.
Everything you can.
This is just an overarching thought for this topic. I know some people that are we'll call it gray area with taxes.
Yeah.
And watch that, because that is, if you get audited and you're doing things that may or may not be allowed to be deducted, or you're rounding or not keeping track, that is an audit nightmare, and you could end up with penalties.
And I've always said,
conservative.
Pay what you owe, but do a good job to know you're only paying what you owe.
Absolutely.
Right? So along with deductions, number 3 is ignoring credits. So deductions are one way of reducing your income. Credits are actually a more efficient way because it straight takes your income right off of there. And so a good example of a credit would be the child tax credit, which for 2023 last year was up to $4,000 per kid if you met income limitations. And so it's a great way of straight reducing your taxable income, because every dollar of those just subtracts off your taxable income.
Yep.
Great way. So you got to file for these things. You got to mark it in there. It's not automatically going to get it. You got to make sure you take those credits that are available. Do your research. Find out what credits are out there, which ones you qualify for. Make sure you grab those.
Yep. We love paying less taxes.
Yes. So number 4, and this is, okay, so those were some mistakes or things that we were talking about missing. This one is more of an understanding. So number 4 is knowing the difference between a Roth IRA or Roth 401k and a pre-tax IRA or 401k.
Yeah, because taxes are very different depending on how you look at it.
Yep. And so remember, this topic is tax mistakes, and the mistake is whether you're taking a deduction this year or in a future year of a tax-free withdrawal. And so if your goal, or you're trying to reduce current taxable income, you'd want to go with the pre-tax option, because every dollar you put in to, we're going to use a 401k as an example, every dollar you put of your money into a 401k, if you put it in pre-tax, you get to deduct that from your income in this year.
Yes.
So if you're in a high tax bracket this year, pre-tax traditional 401k money is a great bucket.
Because you get taxed when you take it out.
Correct.
At the other end, which the thinking is, the debate is always, is my tax percentage effective rate going to be now higher today or higher in the future? And most people would anticipate that their income will be less when they retire.
Yep.
However, that's not always the case. And this is where it gets a little bit hairy when you start factoring in Roths, because Roth, like you're about to get to, post-tax, right?
Yep.
So this is money I already paid taxes on. I took this money home. Now I'm putting money in, and it's going to grow tax-free because I already paid taxes on it. So I'm paying taxes today in anticipation that taxes will be different in the future.
Yep. And so the mistake that we see here is someone not thinking through which tax is the better tax to pay, now or future tax. And so for people in a low tax bracket, the Roth makes more sense.
Yep.
And so that's just more what we wanted to point up. The difference between those two is, when do you want to reduce that tax liability?
Right.
Is it current or future? All right. So that was number 4. Now number 5. This is kind of coming back to what I talked about, deductions. And this one is in particular a unique one because it doesn't have to be grouped with all those other itemized ones. HSA contributions. That's health savings account contributions. If you are in an eligible health insurance plan, and you're eligible, meaning a high deductible plan that meets all the criteria to be HSA compatible, putting money into an HSA, you get a deduct on your tax return that year.
Right.
Even if you plan on using all that money for healthcare, instead of writing your check straight to the doctor's office, put it into an HSA and then pull it back out to
you still
pay
get
it.
The deduction.
You get a deduct
but
it.
you're still spending it anyway.
Yes.
So if you're going to spend it anyway,
Just,
might as well get the deduction.
It's amazing how often we see that as a missed opportunity when you're in an eligible plan. You have to be an eligible plan.
A high deductible.
High deductible plan. Plus, there are rules on how much the out-of-pockets are and all that stuff. Just make sure your plan is eligible.
Well, and there are limits on how much you can put into your HSA, and it's different for an individual versus a family.
Right. So all that to say, though, any kind of contribution, if you're eligible, that's straight deduction on your tax return, even if you're going to use that money.
Yep.
And if you don't use that money, gross tax-free. If you're going to use healthcare expenses, triple tax savings, tax deduction, tax-free growth, tax-free withdrawal if you're using it for healthcare expenses. Great way. But we see that one as, to me, is one of those missed opportunities is, hey, did you spend some money at the doctor's office? Yep. Did you run it through an HSA? Nope. Oh, maybe you should have. If you're an eligible plan, it's a great way.
Or you can reimburse yourself from your HSA. Too.
Yes. So talk about saving receipts.
Yeah.
There is no time limit. No time limit.
In the future, you could have an expense today, as the law is written now, and 20 years from now, if you kept that receipt, you can reimburse yourself after the money grew.
Yep, as long as you have proof.
As long as you have proof. It's interesting.
It's crazy.
All right, we're going to take a break. Dad joke of the week, Josh. Why aren't tax forms very popular at the party?
Ooh, man, why? Why not? I think they would be popular.
You'd think they would. They're kind of fun. They're fun guys, right?
Yes.
No, they're actually, it's very taxing to talk to them.
Oh, it's taxing to talk to them.
Talk to them.
I get it.
Tax joke.
CPAs
love it.
Oh, good times.
All right, we got 5 more. Josh, hit us with this.
All right. Number 6, withholding too little tax along the way.
Okay, so withholding, let's just take a break.
Yes.
Withholding is, now you set this up generally when you start a new job or you get a raise, you get a paycheck, or you have a life change or whatever, but this is you setting up how much the government is going to get out of each paycheck as you're paid.
Yep.
Really with the anticipation that your tax bill should be pretty much covered, and you'd have the right amount already paid to the government for your income tax, right? So that is withholding. That we're withholding every check a little bit to cover your taxes to send to the government.
Yep.
That's what withholding is.
Yep.
So withholding too little.
Yes, and that, like you said, you usually set that up with your employer, especially when you're W-2. You tell them how much to withhold.
Yeah.
And the idea here is you can elect, say, hey, I have 4 kids that are all dependents, so you can adjust your withholding because you're saying, you know, I'm going to be in a different tax bracket, I'm going to get these credits, blah, blah, blah. The idea is if you do too much of that and you withhold too little, in other words, you have too little taken out, when your tax bill comes, you're going to, and if you weren't planning for that and putting money aside, it could be a big burden for you. So too little is a problem. And then number 7 on the other way,
flip side,
withholding too much.
Yeah, this is an interesting thing that many people, it's a cultural thing. And actually companies know about this.
Oh, for sure.
So they know that when people start getting tax returns, their businesses are going to boom. Because, but this is really an impact of people being dumb with their withholding. They're withholding too much money. So you're giving a tax-free or an interest-free loan to the government throughout the year because you're withholding too much of your check so that you get a nice big check in April or May or whatever.
So example is every month I have $1,000 of my paycheck withheld. So through the year, $12,000 is sent to the government. And then I do my taxes and the government says, oh, by the way, now that we finished your taxes, you actually only owed us $8,000.
Right, so you get $4,000 back.
They'll give me, and I'm like, look at this. I just got $4,000 of new money.
But no, I could have used that $4,000 throughout the year.
Yep, I could have invested it.
Could have invested it, or I could have used it, had a good vacation, could have, done all kinds of things with it. So don't do that.
And so it's finding the in-between of those is really where it is. And we'll talk about that coming up, kind of what that means. But before we do, number 8, and this is one where I don't want to get into the nitty-gritty of this because there's a lot of nuances. But there's different types of taxes. There's income tax. This is mainly what we've been talking about. There are also capital gains taxes. And capital gains are the result of buying something and it growing in value when you sell it. So an example, if I buy a stock for $5 and it grows to $8, I just earned $3 for that investment. That's capital gains. When I sell it for $8, I pay tax only on the $3, not the first amount, because I've already been taxed on that money. So I don't pay tax on $8, just $3. But that $3 is gains. It's new money for me. It's not taxed as income. It's taxed in a separate way. And we're not going to get into the nuances. There's breakdown. There's 0, 15, 20, blah, blah, blah. But the point here is understanding when you're going to have those types of taxes in trying to reduce, eliminate, or offset them in that year if possible. Because losses and gains offset each other. So if I sell one stock for $8 and I have $3 gain, let's say I bought another stock for $5, and then I sold it for $2. That one didn't do well.
Yep.
I lost $3. Those two equal each other out, so now I owe 0 taxes because the $3 gain and a $3 loss cancel each other out.
Absolutely.
And so there are some people, and we've talked about this in some of our other podcasts, do what's called tax loss harvesting, where at the end of the year they say, I still like this investment, but I'm going to sell it because it's a loss to just reduce my taxable amount this year of gains, and then I'm going to wait 31 days, and I'm going to buy it back because I still like it. I just don't think it's done very well recently. So the common mistake here is ignoring or not thinking through, in a year you may have a lot of gains, trying to offset or reduce that.
And don't forget that there are different categories of gains too.
Yes.
Short-term and long-term are different depending on how long you held the asset, and they're taxed differently. And then there's the whole wild card, which is up for debate in government all the time, of whether it's going to go crazy how much higher.
We're not even going to touch on whether you're going to tax unrealized gains
or unrealized gains are going to get taxed. Yeah, we're not going to get into that. But just know it's very important to understand that it's different than income.
And it's one that you can actually control more than your income. If you earn income, it shows up. Whereas in this case, you can actually, before the end of the year, offset or reduce it.
Yeah.
And the other's true, and this is, again, going into tax planning, there are some years you may just want to sell things because your actual tax rate for those is 0.
Yes.
So you're going to have tax-free gains based on where you sit in income. So just some planning to think through. A common mistake is just not realizing that.
And this is where it's really important to have a financial advisor, which we talk about all the time.
Yep.
But B, a CPA, and those
working
people
together.
work together so that they can say, hey, here's how much more income we can realize based on your tax bracket without jumping into the next one or whatever. And here's how many losses I can give you. And they just work together. It's a beautiful thing.
All right. Number 9. And this is coming back to, we talked about withholding too much or too little. Number 9 is avoiding tax penalties. And a tax penalty happens when the amount of tax owed in a year is above a certain amount. I think it's $1,000, as well as it's more than what you put aside. And they have all these rules. They have what they call safe harboring. And again, talk to your tax professional about what makes sense for you. But the idea there is you can avoid penalties just by paying enough into your taxes along that year to cover at least last year's 100% or 110, depending on your income.
Yep.
But the idea there is you can at least cover the penalty, because the last thing you want to do is pay additional tax just because you didn't put enough aside. So avoid the penalty. It's an easy thing to do if you're aware of what's going on. The safe harbor is probably the easiest way of doing it. You can pay tax estimates along the way as well, which is just every quarter you pay a certain amount. You kind of spread it out over the year so that by the end of the year, you've paid in what you owe.
And this is another thing where your CPA will pay dividends because they can look at your last year's tax return and say, well, here's your rate. And so we know what your income's tracking to be this year, and we can estimate each quarter, and they'll do it all for you. It's great.
And again, if you're covering 100% or 110% of the prior year, depending on how much you make, that alone safe harbors you.
Right.
And so you're at a good spot then to really be in a good place. So number 10, and this we've already mentioned a couple times, super important, seek help. If you're concerned or wondering, or you have kind of a year that's just different than normal, go get a professional. There's a reason why there are accountants and CPAs out there. There is a lot of nuances to the tax code. The tax code is very complex. So seeking help is a great thing, especially, there may be things you don't even know to help you either reduce your taxable income or plan for future tax issues.
And that's where CPAs, and just like financial advisors, it's not a free service. But oftentimes, and in most instances, if it's a good professional, they will save you more in taxes than they cost you.
Right.
That's usually, or help you along the way enough that they definitely earn their payment for sure. So,
all right.
Josh, final thoughts, taxes.
Yeah, it's, something you got to do every year.
Every year.
And in the end, there are good uses for taxes. Our government does a lot for us to help keep this country being the best place in the world to live. So, taxes have a purpose, and there's a reason why. But in the end, you don't want to overpay. You want to pay what's owed of you and make sure you're doing the right job along the way so that January through April, you're not stressing about where you're going to be.
Yeah.
That's the end result.
Yeah, I guess my final thoughts are we have a very, very complicated tax code, and I would argue one of the most complicated tax codes in the world.
Probably.
And it's also different between, there's multiple layers, right? So you have federal tax, you have state tax, and you have local tax. So you have all of these different tax codes that are very different depending on where you live. It just is important to get it right.
Yes.
And honestly, it's just very hard to know everything.
Mhm.
So that's where professionals are super key.
Yep.
And just keeping tabs on it is good. So, I mean, when it comes to whether you're getting a refund or not, if you're within $500 or $1,000 one way or another, you probably did pretty good
Yep.
at estimating where that should be. And you may not need to would change those withholding allowances. If you didn't, then you probably should.
Right.
At the end of the day, it's going to take some time to figure it out, or talk to a professional.
Yep. Or if you have a life event change, new kid, those type of things,
Yep.
that may adjust your taxes.
Absolutely.
All right. Well, thank you, Austin. Hopefully everybody appreciated that. If you had somebody talking about taxes, because, that's a normal conversation around the lunch table,
totally.
make sure you share this episode with them. If you have any ideas, email us at hello@theinvesteddads.com.
All right. Until next time, have a good one.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.